Monday, January 13th, 2020, Maneco 64, home of alternative economics and contrarian views. This morning, I want to talk about how the debt bubble has been accentuated and inflated even further in 2019 by the central banks, by the actions of the central banks, especially the big central banks like the Fed and the ECB. There's an article here in the FT that's come out over the weekend, and I'll go over it right now, and then I'll look at what the markets are doing this morning. So it says central bank easing triggers record corporate bond issuance. Policymakers fret about soaring debt after companies issue more than $2.5 trillion in 2019. So policymakers are worried about that, even though they're the ones who are creating the problem, so to speak. The policymakers at the central banks, of course. So the article is by Joe Renison from the FT, and I'll go through it right now. It says companies across the globe took advantage of lower borrowing costs to sell a record amount of bonds in 2019. So what does that mean for those of you who are not familiar? Well, selling bonds is basically borrowing money. So you sell a security, a bond, and you get the cash as a corporation. So it's just borrowing money, selling bonds. Don't be fooled that this isn't a debt bubble. Prompting renewed concerns among policymakers about soaring debt levels or levels of debt. Just over $2.5 trillion of corporate bonds were sold over last year, inching past the previous record set in 2017, according to data from Deal Logic. So this is a record. So the debt bubble hasn't gone away. It's still inflating. And that's why asset markets are continuing to go higher. Corporations are borrowing money by issuing bonds. They're probably doing a lot of buybacks as well. We've had help from the Federal Reserve with more QE, even though they don't call it QE. We've had the Fed also pumping money into the repo market. We've had the ECB start QE again. So all of that's helping. Issuance was boosted by supportive moves from major central banks, which reversed course and lowered interest rates, helping to cut the costs of borrowing for all sorts of companies. So these policymakers, central bankers, IMF, they want to have their cake and eat it. They want to pump the system with easy money, and they're concerned now that it's going into the wrong places. But they can't decide. Once the money is in the system, people do, or corporations do, whatever they want with it. The Federal Reserve cut rates by a total of 0.75 of a percentage point over 2019, erasing much of the 1 point rise the U.S. Central Bank administered over the previous year. The European Central Bank also reduced rates and renewed its commitment to buying bonds in a bid to help revive the economy. They don't realize that all these shenanigans, QE, negative interest rates, helping the repo market, it only helps the financial system or Wall Street, speculators. It doesn't flow into the economy because the people on Wall Street, City of London, in the financial sector, they know that it's not safe to lend to the general public because the governments will not bail them out. If you keep the money in the system, in the stock market, central banks and politicians will always have your back, as they showed in 2008. And that's why this bubble is continuing, because they don't have any fear, because they were bailed out about 12 years ago now. So central bank policy has played a significant role in what's happening. Well, I would say no. I don't want to say the word Sherlock. No, Sherlock, said Asif Shirani, a managing director in debt syndicate at HSBC in London. It is clearly contributing to the surge of corporate issuance. Yeah, what a surprise. The record debt sales highlighted tensions between policymakers' desire to keep the costs of borrowing low in an attempt to stimulate economic growth, while at the same time sounding the alarm over rising corporate indebtedness. It goes on to say the World Bank warned in a report last week that the surge of debt issuance in the wake of the financial crisis has been, and I quote, the largest and most broad-based wave of debt accumulation yet. Well, there is one way for them to stop this. It is to withdraw the punch bowl, let rates rise to a normal market level, stop interfering in the markets, that is the central banks, let the markets decide where rates should go, and it would be a lot higher. But of course, they're not going to do that. It would bring their whole house of cards down. And that's why this bubble is going to keep going until it can't anymore, and it would just burst. The Washington, D.C. based development bank, development, I would say more of a enslave the world with debt bank, said that this could be particularly perilous for emerging market economies, as it makes them more vulnerable to external shocks. Last week, the Federal Reserve Bank of New York reiterated concerns over increasing amounts of debt issued by lower-rated companies, which could come under pressure should economic conditions worsen. I'm laughing because here's the New York Fed, who's like keeping this system going by pumping more and more funny money and credit into the system through more not QE, through more liquidity for the repo market, and they're complaining and they're worried about that. Just very weird. As interest rates plummeted, the amount of negative yielding debt reached a peak of over $17 trillion in August of last year, pushing investors to buy riskier corporate debt in order to bolster returns. I spoke over this weekend about the Minibonds debacle in the UK. As central banks pursue this policy of low rates, negative rates, investors are pushed into riskier investments like mini bonds, which are not even listed. And as you saw from my video earlier this weekend, or this past weekend, not earlier because we're on Monday, investors have lost almost 250 million pounds in these mini bonds, which promise like 8 or 10% yield. At the same time, companies have taken advantage of low borrowing costs and high demand to sell more debt. Borrow more money, sell more debt, allowing themselves to drop down the credit rating spectrum. Is it a concern? Yes, it is something that needs to be watched, said Shirani of HSBC, but it doesn't feel like, in the short term at least, it is something that will turn ugly. No, it will just turn ugly in the medium to long term, Mr. Shirani. The trend has shown little sign of abating in 2020. There you go. It's going to continue. Analysts at Bank of America noted that higher quality investment grade bond issuance hit 69 billion in the US last week. So it's started already. The second highest weekly volume in history, after a record blowout in early September last year. Europe, meanwhile, notched its best ever week for corporate bond issuance, selling more than 90 billion euros. It's funny how they say the best ever. How can borrowing money be something good? They should say the worst ever money borrowing exercise, in my opinion. But everything's turned upside down. Savings is bad. Debt is good. That's the whole system. So I'll finish off here. This is from Marco Baldini, head of European Bond Syndicate at Barclays. He says, we're still seeing the feel-good factor in the markets as a result of continuing accommodative central bank policies, which help to make funding costs so attractive that companies are continuing to issue historically high levels of debt. Why does it keep going then? Well, because these people benefit from it. The bankers at Barclays, HSBC, and elsewhere, they make the fees when these corporations borrow money by issuing bonds. And yeah, it just keeps the game going. I think policymakers saying their word is just them trying to kind of make an excuse when things go bad, that they warn people about it, even though they're the ones who are creating this problem. So there you go. The debt bubble is alive and well, and we're continuing to see record amounts of borrowing through bond issuance in 2019 and already in the first week of 2020. So with that, let's go and look at the markets, see what they're doing this morning. It's 8:15 a.m. London time. So last Friday, stock markets didn't do very well. U.S. Stock markets, that is. The Dow finished down 0.5%. S&P down just under a third. NASDAQ about 0.25% down. We had those non-farm payrolls. They were a little weaker than expected. This morning, the market's a little higher. The Dow futures is up about 70 points or 0.25%. S&P futures likewise up 0.25%. NASDAQ 100 future is up 0.33%. Precious metals have drifted lower a little bit. Spot gold is at $1552.50, down about $9. Very volatile week last week. We spiked overnight, beginning of the week. I think it was Monday or Tuesday, with the problems kicking off in Iran and Iraq. Spiked up to 1610. That was a very brief spike up there. Didn't stay there very long. We came down, closed the gap at around 1553. Dipped very quickly down to 1540, and we actually closed a week higher last week compared to the previous week at 1562. I expect continued consolidation for a while here in the precious metals, but the longer term trend is, in my opinion, higher. Spot silver down 0.25%. Just below 18 at 17.98 right now. The currencies, we've got sterling actually down quite a bit this morning. I haven't looked at the what's affecting that at the moment. It's just broken below 130. Cable, it's down 0.5% at 129.95. Euros pretty steady, 111.24 unchanged. Dollar's a little higher versus the yen. About 0.15% at 109.63. Dollar down 0.25% versus the Chinese yuan at 689.50. Crude oil pretty much unchanged. WTI 58.92. Brent 64.55. Finish off with the bond market, U.S. Treasury market. The 10-year yield is unchanged. Just below 184. So don't be fooled that central banks are doing a good job. Of course, most of you probably know that they're not. But all their policy is doing is inflating the debt bubble. How do you protect yourself? Again, well, diversify your investments, I guess. Have some precious metals, as I've always said. Precious metals, gold and silver, is more like saving. A lot of people ask me this question: how much should I hold? Well, it's almost like asking someone how much savings should I have. That's the way I look at it. And Will we see a gold standard again? That's another question I get asked. Not by choice from the policymakers, maybe by necessity if everything implodes. But you can be on your own gold standard or silver standard yourself by choosing to keep some of your savings or cash savings in precious metals. Yeah, and I do call precious metals cash because that's what they are. The cash that we call cash now, the paper money, is actually a promissory note that used to be able to be exchanged for cash, gold or silver. There you go. If you enjoyed this video, please hit the like button. Subscribe to the channel if you haven't yet. Make sure you hit that little notification bell above to be notified of all my new videos. You can also follow me on Twitter, BitChute, Steemit, and DTube. I wish you all a great start to the week. Take care. Bye.